Hello everybody, this is Gary Mrzinski. Welcome back to Chapter 8. This is Part B. In Part A we discussed profit, and we'll talk more about profit, but let's return to the concept of market structure. Within an economy, any given product market lies somewhere on a continuum like you see in this graphic on the top of the slide. What's varying here in this continuum is the level of competition. All the way to the right, that's less competition. The least amount of competition would be a monopoly. That is a market structure. That's going to be Chapter 10, and that's where there's one seller. All the way in the other direction, perfect competition, that's what we're talking about in this chapter. That's where there's lots and lots of sellers, and it tends to be a standardized product. And then in between, we have monopolistic competition and oligopoly. A special case of oligopoly is duopoly. That's when there's only two sellers. Sometimes we see this in very local markets. You might only have two choices of who to buy a product from. That's a duopoly. That's one kind of oligopoly. But in general, an oligopoly is where there is just a few sellers, or a few sellers that collectively have the majority of the market share. And then there's monopolistic competition. That's where there's lots more sellers. Most of the product markets in our economy are that kind of market structure. So you know monopoly when you see it. That's when there's only one seller. You know perfect competition when you see it. That's when it's a standardized product and there's hundreds or even thousands of sellers. The question is, how do you distinguish between oligopoly and monopolistic competition? With oligopoly, the market share is concentrated among a few producers or sellers, but how concentrated does it need to be to not be considered monopolistic competition? There actually is a measure that we will use, and we'll talk about that coming up. So oligopoly is Chapter 11. Monopolistic competition is Chapter 12. So here we are again in Chapter 8. We're going to talk about perfect competition. So again, perfect competition, there are lots and lots of sellers, so no one seller has market power of any sort. Monopolistic competition, there's many firms. It's not a standardized product anymore. Usually it's a differentiated product, so that gives sellers some power, some control over their price, and there's not quite as many sellers as there is with perfect competition. Oligopoly, just a few sellers who have most of the market share or the majority of it. And then monopoly, just one seller. All right, so we're talking about perfect competition in this chapter. There are many, many firms, hundreds of firms selling the product in this market, or even thousands. So an example of this would be the milk market. Dairy farmers sell their product in a purely competitive or perfectly competitive market. By the way, pure competition and perfect competition, these are interchangeable terms. So there are thousands of dairy farms. Even just in Pennsylvania, we have 5,000 dairy farms. So they're small producers. Now they sell their product to milk processors, and there's fewer of them. It's not quite as, it's not pure competition in the milk processing market, but in the dairy farm market, the dairy farmer that produces dairy products, that is pure competition. And it's considered standardized product. No one dairy farmer can tell the difference between their milk and a competing farmer's milk. It's considered a standardized product. Low entry barriers. There's no significant barriers to entry. It's easy to set up a farm and buy cows and be able to produce milk. And each firm, so this is the important part, is a price taker. Each producer in a market that's perfect competition or pure competition is a price taker. They must accept the market price. They have no control. They have no market power. They need to charge exactly whatever the market price is. The graph on the left shows a typical market supply and demand curve for really any product market, but in this case we're talking about a market that's pure competition. Well, it looks pretty traditional, right? Upward sloping market supply curve, downward sloping market demand curve, and where they intersect is equilibrium. That determines the market price. But now look at the graph on the right. For the individual firm, one thing we're going to be doing for the rest of this course, for the next 5 chapters anyway, is we're going to be looking at graphs of the market and then graphs of the individual firm. So in this case, this is the demand curve the individual firm experiences. Look at that. It's completely horizontal. If you remember from chapter 5, that means this is purely elastic demand. And what this would mean is the seller, the dairy farmer, must charge the market price. You might think, well, is there any incentive to charge a penny less than the market price just to get more business? No, because you can sell as much as you decide to produce at the market price, so why would you take profit away from yourself and lower your price? You wouldn't do that, right? You also wouldn't charge a penny over the market price because, technically speaking, all the customers would go to the other sellers because this is a standardized product. Your product's not superior in any way. There's not a quality issue. It's a standardized product in consumers' minds. So this is a case where the seller is a price taker, and so the demand curve is horizontal. This only happens with pure competition. And again, this is an explanation of why the demand curve for the individual firm is strictly or completely horizontal. So then there's no question in the seller's mind of what price to charge. The only question is, how much should we produce? Well, you would want to produce the quantity per unit time, per month, or per week that allows you to maximize profits. That's where we're going. We want to figure out how much should a dairy farmer produce to maximize profit. That's the only thing to decide on. In chapter 7, we talked about cost, and you're going to be seeing those curves again, but we didn't talk about revenue. So let's now talk about revenue, total revenue, because this is part of the decision. Remember, profit is total revenue minus total cost. So you need to think about revenue, and we're going to start graphing it. All right, so if you graph revenue in a purely competitive market for the individual firm, remember, price does not change as quantity changes. No matter how much you produce, you're going to charge the same price. So that means there's a linear relationship between total revenue and quantity, right? When we graph total revenue against quantity, it's going to be a straight line. It's a linear relationship. I'll show you the graph on the next slide. So there it is. And in this case, this was the t-shirt business example, and a t-shirt selling for $8, it looks like. No matter how much you charge, how much you produce, you're gonna charge $8. And so then it's 8 times 1 is $8 total revenue if you're producing 1. 8 times 2 is $16 total revenue if you're producing 2 per day, and so on. So when you graph that is a straight line. Do you remember total cost from chapter 7? What total cost looks like? It's this S-shaped curve. First of all, it goes uphill, right? Because total cost increases as Q increases. As you go left to right on the curve, on the graph, Q is going up. Q is increasing. The number that you're selling per day goes up. But it's not a linear relationship because total cost in the beginning, the more you produce, this is the very beginning at very low levels of Q. Total cost increases at a decreasing rate because you're experiencing increased return. Do you remember this? Then, beyond some point, you start to experience diminishing returns, diminished returns. The law of diminishing marginal product. Remember the example of the carpentry shop. You're sitting in a carpentry shop, and at very low levels of Q, maybe you have 2 employees to produce that level of Q, but you have 4 machines, 4 major pieces of equipment. If you increase your workforce to 4, there might be actually more productive per worker because now you have 1 worker per machine to use, so that's increasing returns. So the variable cost per unit actually goes down even though total cost is increasing. But then if you say hire 4 more and now you have 8 employees sharing the 4 machines, now the average productivity of the workers goes down, even though you're producing more, which is your goal. Well, this means that the variable cost per unit is going up as the workers get less productive per person. And maybe you add 4 more, now you have 12 sharing the fixed plant. And then you have 16. So remember, that was the law of diminishing returns that we talked a good deal about in Chapter 7. This means that beyond some certain point, when you're experiencing diminishing returns, total cost increases at an increasing rate, and that gives us the S-shaped curve, which looks like this. So as you go from left to right, total cost increases at a decreasing rate. That makes it sort of level off and almost plateau, and then at point Z, total cost starts to increase at an increasing rate. That's where diminishing returns are happening. So now let's bring the total revenue curve into this graph. And so there it is. Now there's 2 important intersection points. This would be point F and point G if you're looking at the x-axis. Point F and point G. To be profitable, you need for total revenue to be larger than total cost. Total cost is that blue S-shaped curve. Total revenue is the green straight line. You want for total revenue to be above total cost. Well, that only happens between F and G, right? That range of output. Remember I told you when you're experiencing increased returns at very low levels of Q, you might think that's the best place to be. No, because you actually would not be profitable. And that would be levels of Q less than F on the x-axis. See how it says losses? You're not producing enough to pay for your capital, right? So if you had 2 employees and 4 machines, you're paying for those 4 machines. That's part of your total cost. That's part of your fixed costs. You're not producing enough to be able to pay for the size of the fixed plant you have if you only have 2 employees and producing small amounts, or even 4 employees. You need to produce more than that. So you're profitable, in this example, if you're producing somewhere between F and G, whatever levels of Q those are, whatever number of t-shirts per day that is, that's where you're profitable. Now I told you in the last chapter, we don't really use the total cost curve, and in this case the total revenue curve with it, to do our analysis because it's too difficult to figure out from this graph where is profit maximized. It would be maximized where there's the largest vertical distance between the green curve and the S-shaped blue curve, right? Well, it's hard to visually pick that out. Now, it's labeled here for us, R and S. That's the largest vertical distance between total revenue and total cost, and that happens at, on the x-axis, H, point H, whatever level of output that would be. That's where profits are maximized. But it's not obvious to you. You'd have to bring out some sort of measurement instrument if you're looking at a graph and trying to determine where that vertical distance is the maximum. It's much easier to pick out if you're looking at the average costs graph, and that's what we're going to do. But just to show you what these total costs and total revenue curves look like for the purely competitive firm, there it is. We talked about marginal cost in the last chapter, but we didn't talk about marginal revenue yet. Marginal revenue is the increase in total revenue when you increase output per unit time. So imagine that you're producing 10 per day. You have some amount of total revenue from that, right? Whatever your price is times 10. Like if it's the $10 or the $8 t-shirt, if you're producing 10 per day, your total revenue per day is $80, right? If tomorrow you start producing 11 per day, now your total revenue goes from $80 a day to $88 a day. The marginal revenue is $8. The marginal revenue of the 11th unit of output is $8. And if you increase by more than 1, like if you increase by 2, then the marginal revenue it would be 16 divided by 2, which gives you 8 again. So if you're increasing by more than 1 Q, don't forget to put whatever that change in Q is in the denominator. We're usually thinking about increasing by 1 in our simple examples, but just to let you know, you could run into that. So, price is equal to marginal revenue. If you increase by 1 more, you're producing 11 today, whereas yesterday you were producing 10 per day. Your total revenue should go up by whatever the price is. You're producing and selling 1 more. So price is equal to marginal revenue, but this only happens with pure competition. It does not happen with the other market structures, and I'll remind you of that. An example that is developed in the chapter in your textbook is a catfish farm. This is another simple example of a purely competitive market. And this catfish farm, you can see the data there given to you. A bushel of catfish are selling for $13. You can produce 1, 2, 3, 4 bushels per day, and you can see how total revenue goes up. It's a linear relationship. Marginal revenue is also $13. If you're producing 1 more bushel today than you were yesterday, then your total revenue should go up by whatever the price is, $13. All right, so to further develop this example, the fixed plant in this case is a pond. That is your fixed plant. The rate of production is the number of fish harvested from the pond every day, and that's measured in bushels of fish. Fixed costs, you're leasing the pond for $10 per day, and that also includes electricity to keep the pond oxygenated. I guess that's important. Now, variable cost is just the labor cost in this simple example, the labor to net and sort the fish. There's the marginal cost curve. Do you remember that? Marginal cost, when you graph it, let me remind you what it is. Marginal cost is if you're producing 10 today and 11 tomorrow, your total costs are going to go up too, right? The amount that your total cost increases when you increase production by 1 is the marginal cost. The more you produce, the more marginal cost rises. Marginal cost will rise the more you produce because of the law of diminishing returns, which we hammered away at in chapter 7. So when you graph it, marginal cost is a curve that increases, goes uphill, but it increases at an increasing rate. So it has a curve to it, and there it is graphed. So we're given this data for this simple example, and you can see how, depending on how many bushels per day you produce, that's Q, that's the first column, you have some amount of total cost. And that's an increasing function, obviously, but it increases at an increasing rate. The rate that it increases is the marginal cost. So you can see the marginal cost in its column is rising the more you produce. So how much should you produce to maximize profit? There is a profit maximizing rule. And the profit maximizing rule is, I'll skip right to the end. And this is a rule that you can apply to any market structure. Produce that level of Q for which marginal revenue equals marginal cost. But remember, in this example, with pure competition, marginal revenue and price are the same thing. So this slide, which is taken right from your textbook, doesn't show you marginal revenue. It shows you price instead. By the way, whenever you see P, that means price, not profit. When I mean profit, I will spell out the word profit. So whenever you see P, that always means price. All right? So if you're producing at a level of output where marginal cost is greater than P, producing an extra unit of output, increasing Q, will add more to total cost than it adds to total revenue. This means that total profit will decline, so you would not want to do that. If increasing Q results in a situation where the price is greater than the marginal cost, you should do that, because the price is what you're adding to total revenue, marginal cost is what you're adding to total cost. You're adding more to total revenue than you're adding to total cost. So you should do it. So as long as the price, when you increase Q, as long as the price is greater than the marginal cost of that increase, you should do it. you should stop when you get to the point where price is equal to marginal cost. That is the best you can do. That's where profits are maximized. And this is pure competition, so marginal revenue and price are the same thing. After this chapter, what we're going to say is the profit maximization rule is where marginal revenue equals marginal cost. That's where profits are maximized. In this case, marginal revenue and price are the same thing, so we can say profits are maximized where price equals marginal cost. This makes it real easy for us to identify the profit maximizing level of output on a graph if we're graphing the average cost curves and the marginal cost curve, and I'll show you how that works. So in this graph, which is taken from the data below, you can see we have a marginal cost curve, that's the blue curve. Remember that the demand curve for the individual firm, this graph represents the individual firm. The demand curve for the individual firm is that horizontal green line. That is the demand curve. Now, one thing I should point out is the demand curve is where we get P from, right? That gives us the price for any level of output, for any Q. So it will be labeled as P. It's the P curve, the price curve, but it's the demand curve, all right? That gives you the price. And since the price is not changing, in this case it's 13, we have a horizontal line extending from the y-axis at $13 because the price will be $13 no matter what Q is. That's also the marginal revenue. So you will produce, to maximize profit, where marginal revenue is equal to marginal cost. In this case, where price is equal to marginal cost. Well, that's very easy to find, right? You're just looking for the intersection of these two curves. And that happens, in this case, at Q equal to 4. So this means if you produce 4 bushels of fish per day, given your cost structure and given the market price, that's where you will maximize profit. Q equal to 4. It's that simple. That's what we're going to be doing for the next few chapters. No matter what the market structure is, we're going to look for the marginal revenue curve and the marginal cost curve. And then we're going to look for where they intersect. The marginal revenue curve in this case is the price curve or the demand curve, and so there it is. Here's the profit equation, and we're going to come up with a useful version of it. Remember, profit is total revenue minus total cost. Total revenue is P times Q. If you want to express total cost in terms of Q also, you could say total cost is equal to average total cost times Q, right? Because average total cost is total cost divided by Q. So we rearrange that to say total cost is equal to average total cost times Q. All right? Now that's useful because now we can factor out the Q and we end up with profit equals the quantity P minus average total cost times Q. And 2 slides from now, I'll show you why that's useful. So again, the reason that we don't use the total revenue and total cost curve to determine the profit maximizing level of output is because it's just too difficult visually to pick out the point at which the vertical distance between these 2 curves is the greatest. In this case, it's labeled for us. It happens at Q equal to 4, but it's not obvious by looking at this graph. It's not obvious at all. It's much easier if you're looking at the average cost curves and the average revenue curve, which is the price curve, right? And here it is. All right, so now we have added to this the average total cost curve for this firm. We have the marginal cost curve, that's the blue uphill curve that's increasing at an increasing rate. Average total cost, remember that's a U-shaped curve. And then we have price, or this the demand curve for the individual firm. This is all for the individual firm, the horizontal line. So here's the process you're going to follow for the rest of this course, well, for the next 5 chapters anyway, to figure out the profit, where profits are maximized and how much profit it would be. All right? So you're looking for the intersection of marginal revenue and marginal cost. Marginal revenue is the price curve, the demand curve, right? That's the horizontal curve. Marginal cost is that uphill curve, and it's labeled marginal cost. Where do they intersect? Q equal to 4 on the x-axis. All right, now, what is price when Q is equal to 4? $13, right? What is average total cost when Q is equal to 4? And from the average total cost curve, just go up to where the average total cost curve is, and that happens at $11. So if you're producing 4 bushels per day, your average total cost is $11, and that's given to us in the table, right? So if your price is $13 and your average total cost is $11, then that's $2 per unit times 4 units. That's $8 of total profit. Use the equation. Profit equals the quantity, price minus average total cost, 2, times quantity, 4. 2 times 4 is 8. $8 is total profit. Here's a generic graph for a purely competitive firm. Again, the horizontal demand curve where price comes from, that's also marginal revenue. We have the U-shaped average total cost curve, and then the marginal cost curve increasing at an increasing rate going uphill. Remember that the marginal cost curve intersects the average total cost curve when it's at its minimum, at the bottom of the U. You might think that's the best place to produce, but it's not. I mean, that's the biggest vertical distance between average total cost and price, which is average revenue. That gives you the largest per unit profit, but that's not your goal. Your goal is not to produce the level of Q where per unit profit is maximized. You want to produce where total profit is maximized. That happens at point B, at the intersection of marginal cost and marginal revenue, which in this case comes from the demand curve because it's pure competition. Point B. And how much should you produce? Q sub B on the x-axis, Q sub B, whatever Q that is. That's how much you should produce per day or per week. All right? And when we get to part C, this was part B, chapter 8, part C, we're going to talk about what's called the shutdown decision. Believe it or not, in the short run, you will choose to produce at a loss in some cases. In other cases, you will choose to shut down, and then Q is equal to 0. So we will discuss that in chapter 8, part C. See you there.